America's housing crisis has changed shape. The danger is no longer just bidding wars or runaway rent. It is a market where millions of people can technically find a home for sale or an apartment for rent, yet still cannot make the monthly math work. That distinction matters. A market can cool and still be brutally unaffordable. Listings can rise while buyers stay trapped. New apartments can open while low-income renters remain squeezed. And a homeowner with a fixed mortgage can still get hit by costs that refuse to stay fixed. What follows is grounded in federal housing data, major housing research, and recent market reports. By the end, you will see why this crisis feels so strange. Demand is softer, supply has improved in places, but the basic promise of affordable shelter is still slipping away. And the most uncomfortable part is this: there is no single villain big enough to explain it. High prices, high rates, local building limits, construction costs, insurance, taxes, investor behavior, weak assistance, and years of underbuilding all collide in the same household budget. Start with the price tag. In June 2026, the median price of an existing home sold in the United States reached about $440,600. That was not a luxury home statistic. It was the midpoint of homes actually changing hands. A median is not the price everyone pays, and local markets vary wildly. But it tells you something important. The national entry ticket into ownership has moved far beyond what many middle-income households can comfortably finance. Even more revealing, home prices did not need another pandemic-style surge to keep the crisis alive. Prices were rising much more slowly by 2026, yet the level they had already reached remained punishing. That is the first trap in the new housing crisis. Slower price growth is not the same as affordable housing. If a mountain stops getting taller, you are still standing on a mountain. Then comes the mortgage rate. In mid-August 2026, the average 30-year fixed mortgage rate was about 6.67%. That is far below the peaks Americans have seen in other eras, but it hits very differently when home prices are this high. A rate is not just a percentage on a screen. It determines how much of every future paycheck gets converted into interest. On a large loan, a few percentage points can separate a manageable payment from a payment that destroys the rest of the household budget. This is why people who remember higher mortgage rates decades ago can miss what makes today different. Buyers then often faced much lower home prices relative to income. A high rate on a smaller principal is not the same burden as a high rate on a huge principal. The crisis is therefore a multiplication problem: expensive house times expensive money. Either one can hurt. Together, they can shut out buyers who look financially solid on paper. Major housing researchers modeled the monthly cost of buying the median-priced home at roughly $3,100 in late 2025, including the mortgage and standard ownership costs used in their calculation. In early 2020, the comparable modeled payment was around $1,700. That is an enormous jump in the monthly hurdle in only a few years, even though household incomes did not rise anything close to the same proportion. Think about what that difference does. It can absorb money once used for retirement contributions, childcare, debt payoff, travel, repairs, or simply the ability to survive a surprise bill without putting it on a credit card. A housing payment is not one line in a budget. At this scale, it can become the budget's organizing principle, forcing almost every other decision to bend around it. The same research estimated that a household needed income above $120,000 to afford that modeled payment under its assumptions. In early 2020, the required income was about $66,000. That does not mean every buyer must earn exactly that amount. Down payments, debts, taxes, insurance, rates, and local prices differ. But the direction is devastatingly clear. The income gate moved upward much faster than many families could follow. This helps explain why people with respectable careers can feel poor when they shop for a home. They may be earning more than their parents ever did, yet the housing system is asking them to clear a much higher financial wall. Officially, they may be middle income. Functionally, in a high-cost market, they can be locked out of the asset that helped earlier generations build wealth. Existing home prices were roughly 54% higher nationwide than in 2020, according to a major 2026 housing report. That increase happened before many households had time to rebuild savings from one shock to the next. When prices move that far, the damage is not limited to people buying now. Higher values can feed larger down payment targets, higher property tax bills in many places, bigger insurance exposure, and more expensive repairs or replacement costs. For owners, rising values can create wealth on paper. For outsiders trying to buy in, the same increase becomes a barrier. The exact same price movement can enrich one household and exclude another. That split is one reason housing debates become so emotionally charged. Policies that push prices sharply downward could hurt existing owners, while policies that protect values can preserve the very affordability problem blocking new buyers. Another striking measure is the price-to-income ratio. Nationally, existing home prices have been near 5 times median household income, far above the rough ratio of 3 that was common in the 1990s. No rule says a home must cost exactly 3 times income. Interest rates, household structure, taxes, and local economics change. But when the ratio climbs this far, the market needs some combination of higher incomes, lower prices, cheaper financing, or smaller housing expectations to restore balance. Instead, many households are stretching every lever at once. They look farther from work, accept smaller spaces, delay marriage or children, use family help, take on longer commutes, or simply keep renting. The shock is not that Americans suddenly stopped wanting homes. It is that the distance between wanting one and qualifying for one has become a structural feature of the market. Now look at sales. Existing home transactions remain near levels not seen in roughly 3 decades. That sounds like the setup for a classic crash, but prices have remained remarkably stubborn in many markets. Why? Because weak demand has been meeting restricted supply. Many owners who refinanced or bought when mortgage rates were far lower do not want to trade their old loan for a much more expensive new one. This is the mortgage lock-in effect. A homeowner may want another bedroom, a shorter commute, or a different state, yet moving can mean surrendering a cheap loan and financing the next house at a much higher rate. So the market freezes. Buyers pull back because payments are painful. Sellers hold back because moving is painful. Fewer transactions occur, but limited desirable inventory can keep prices from falling enough to rescue affordability. The national homeownership rate was about 65% in the second quarter of 2026. That means ownership is still normal for a majority of households, even while entry into ownership has become unusually difficult for newcomers. This creates a misleading headline risk. A stable national ownership rate can make the system look healthy while younger or first-time buyers are struggling underneath the average. Housing is full of averages that hide timing. Someone who bought before the price surge and refinanced at a low rate lives in a completely different financial reality from someone buying the same house today. Two neighbors can occupy similar homes, earn similar incomes, and face monthly ownership costs separated by a breathtaking amount simply because they entered the market in different years. That timing divide becomes obvious in first-time buyer data. In the latest major national survey covering recent buyers, first-time purchasers accounted for only about 21% of buyers, a record low for that survey series. That share is not a perfect measure of every home transaction in America, but the signal is hard to ignore. The market has become increasingly dominated by people who already possess housing equity or other financial resources. First-time buyers are not just competing with other first-timers. They often compete with repeat buyers who can roll equity from one home into the next, reduce the loan they need, or make offers with fewer financing constraints. Homeownership has always rewarded earlier entry. What feels different now is how strongly yesterday's housing wealth can determine who gets to participate tomorrow. The median age of a first-time buyer in that same survey reached 40, another record for the series. Historically, first-time buyers were commonly much younger. That matters because delay has compounding effects. A person who buys later has fewer years to pay down a mortgage before retirement and fewer years for home equity to grow, assuming values rise over time. It can also change family decisions. Buying after children arrive is very different from buying before them. Childcare expenses, school location, commuting, and space needs can collide with the down payment at exactly the same moment. The crisis is not merely making houses expensive. It is rearranging the timeline on which Americans form households, build wealth, and make long-term commitments. Repeat buyers reveal the opposite side of that divide. In the same survey, their median age was 62, and about 30% bought with all cash. Cash is not automatically proof of extreme wealth. Some buyers are using proceeds from a previous home. But that is precisely the advantage. Equity accumulated in an earlier housing era can become purchasing power in the current one. A financed first-time buyer may be calculating every fraction of a rate and every dollar of closing cost. A repeat buyer with deep equity can sometimes make the mortgage itself a smaller part of the decision. This is how a housing market can gradually become more favorable to people who already own housing, without any secret meeting or conspiracy. The balance sheet does the sorting. Sellers are staying put longer too. The median time owners had lived in the home they sold reached about 11 years in the latest National Buyer and Seller Survey, the highest level reported in that series. Some of that reflects aging homeowners and normal life choices. But the financial incentive to stay is powerful when an owner holds a mortgage rate that may be impossible to replicate today. Longer tenure sounds harmless until you remember that every household that does not move is also a home that does not come to market. Mobility and inventory are connected. A frozen market can therefore punish both sides: the young household that cannot buy, and the established household that feels financially trapped in a home that no longer fits. Behind all of this sits the supply problem. A major housing finance study estimated that the nation was short roughly 3.7 million housing units relative to long-run demand as of the third quarter of 2024. That estimate is not a literal count of empty bedrooms Americans need tomorrow. Housing shortages are modeled, and different researchers use different assumptions about vacancies, household formation, geography, and normal market conditions. But the broad conclusion is consistent across serious research. America has not built enough housing in the places and price ranges where people need it, especially after years of weak construction following the financial crisis. Supply is slow-moving. You can change a mortgage rate in days. You cannot create millions of well-located homes in days, because land, approvals, infrastructure, labor, financing, and construction all take time. Here is another uncomfortable fact. There is no single universally accepted number for the housing shortage. Credible estimates have differed by millions of units depending on method and year. That uncertainty does not mean the shortage is fake. It means housing is local and complicated. An empty house in a shrinking town does not solve a shortage near a job center hundreds of miles away. It also means slogans can be dangerous. Saying America needs one exact number of homes can hide the harder question: what type of homes, at what price, in which locations, connected to which jobs, schools, transportation, and services. The real shortage is not merely a national unit count. It is a mismatch between people, incomes, places, and the homes actually available to them. Vacancy data show why the story is changing. In the second quarter of 2026, the rental vacancy rate was about 7.3%, while the homeowner vacancy rate was only about 1.2%. Rental vacancy has recovered from unusually tight pandemic-era levels. That is good news for renters in markets where new supply has arrived. More empty apartments can force landlords to compete harder with concessions or slower rent increases. But a higher national rental vacancy rate does not mean low-cost housing is suddenly abundant. A vacant new apartment charging a premium rent does not help a household that can only afford a modest unit. This is the central contradiction. America can have more available apartments and still have an affordable housing shortage at the same time. Local supply proves that building can matter. In the Austin area, heavy construction pushed apartment vacancy sharply higher from its earlier level, and for-sale listings expanded dramatically compared with 2021. In the Chicago area, where construction was more subdued, the increase in apartment vacancy was much smaller, and for-sale listings remained below their earlier level in the research comparison. These are not controlled experiments. Cities differ in jobs, migration, land, taxes, and demand. Still, the contrast is a warning against pretending supply never affects price pressure or consumer choice. Build enough in a growing market and landlords or sellers eventually face more competition. The argument is over how fast that relief arrives, who benefits first, and whether new supply reaches lower-income households. Now for one of the harshest facts in the entire story. Over the last decade, the number of rental units with inflation-adjusted rents below roughly $1,000 fell by about 7 million. Those homes did not all vanish physically. Some were demolished, but many shifted into higher rent categories. A unit can remain standing and still disappear from the affordable inventory. That is why construction totals can mislead. If the country adds expensive apartments while losing cheap ones, the overall housing stock can grow while the lowest-income renters feel as if the walls are closing in. The crisis is not only that America needs more housing. It needs more housing that ordinary incomes can actually carry, and it needs to preserve lower-cost homes that already exist. The ownership side has a similar hole. In March 2026, the number of homes listed for sale that were affordable to households earning $75,000 or less was about 60% below the level in March 2019. That statistic slices through the argument that buyers should simply shop cheaper. In many markets, the cheaper tier is exactly where inventory has been thinnest. Small starter homes are difficult to produce profitably when land, permitting, labor, materials, financing, utility connections, and fixed development costs are expensive. Builders often need higher sale prices to make projects pencil out, so the market can produce homes while failing to produce enough entry-level homes. Quantity matters, but price mix matters too. For extremely low-income renters, the gap is even more severe. About 11 million such renter households compete for roughly 3.8 million rental homes that are both affordable and available to them. That leaves a national shortage of about 7.2 million affordable and available rentals for the lowest income group. The phrase affordable and available matters because a cheap unit occupied by a higher income household is not available to the household that needs it. This is why simply pointing to all low-rent units can overstate real access. Housing has to be affordable at a household's income and actually open for that household to rent. At the bottom of the market, the problem is not a mild inconvenience. It is mathematical scarcity. Put differently, there are only about 35 affordable and available rental homes for every 100 extremely low-income renter households nationwide. And no state has enough for that group. Some states are less short than others, but the deficit is national rather than confined to a handful of famous coastal cities. When 100 households are effectively competing for 35 viable homes, advice about budgeting has limits. Better budgeting cannot manufacture the missing 65 units. Personal responsibility matters in personal finance. But when the available supply is structurally smaller than the number of households who can afford it, the problem is bigger than individual discipline. Rent burden shows the human result. In 2024, about 22.7 million renter households were paying more than 30% of income for housing and utilities. That was roughly 49% of renters, a record high in the latest major housing analysis. The traditional 30% line is not a magical threshold, but crossing it leaves less room for everything else. Some high-income households can spend above 30% and remain comfortable. For low-income renters, the same ratio can mean skipping medication, delaying car repairs, cutting food quality, or taking on debt. Affordability is therefore not only about the rent amount. It is about what remains after rent is paid. Severe burden is worse. About 12.1 million renter households were spending more than half of their income on housing and utilities in 2024. That is roughly 1 out of every 4 renter households. Imagine half of each paycheck disappearing before food, transportation, healthcare, childcare, debt payments, clothing, phone service, or emergencies. A household can survive that ratio for a while by sacrificing, doubling up, working more hours, borrowing, or falling behind. But those coping strategies carry their own costs. This is how a housing problem becomes a health problem, a family stability problem, a credit problem, and eventually a labor market problem. Among renters earning under $30,000 a year, the numbers are even more brutal. About 83% were cost-burdened, and roughly 66% were severely burdened. At that income level, the problem is not that people failed to discover a clever mortgage hack. The gap between market housing costs and earnings is simply too large in many communities. Raising incomes helps. Adding lower-cost supply helps. Rental assistance helps. Preserving existing affordable units helps. None is a complete substitute for the others. The deeper lesson is that the housing crisis becomes most unforgiving, where low income meets scarce low-cost supply. Here is the statistic that turns percentages into a kitchen table reality. For roughly 13 million renter households earning under $30,000, the median amount left after housing was only about $210 per month. In 2019, adjusted for inflation, the comparable residual amount was roughly $410. In other words, the small cushion these households had was cut dramatically. $210 is not grocery money plus everything else. It is everything else: food, transportation, medicine, school needs, clothing, phone bills, emergencies, and every small surprise life produces. When housing takes first claim on income, inflation outside housing becomes more dangerous. A modest increase in food, electricity, or car insurance can become the bill that finally breaks the budget. Homeowners are learning that a fixed-rate mortgage does not create a fixed cost of living. From 2019 to 2025, nationwide property taxes rose about 31%, according to data cited in a major housing report. Over the same period, average monthly homeowners insurance premiums in the cited data rose about 72%, reaching roughly $201 per month. Those figures vary dramatically by location and property, but they expose a major weakness in the phrase fixed housing payment. Principal and interest may be fixed. Taxes, insurance, utilities, maintenance, and association fees are not. A homeowner can do everything conventionally right, lock a long-term mortgage, and still watch the monthly escrow payment climb. Insurance is becoming one of housing's least appreciated affordability threats. Risk from hurricanes, wildfire, hail, flooding, rebuilding costs, and reinsurance pressures can translate into higher premiums or fewer coverage options in exposed areas. This does not mean climate risk is the only reason premiums rise, nor does every region face the same danger. Insurance pricing also reflects construction costs, regulation, litigation environments, local loss history, and insurer strategy. But the housing market cannot ignore insurance. A home that looks affordable at the purchase price can become unaffordable if coverage costs surge or if a lender-required policy becomes difficult to obtain. The old affordability conversation focused on price and mortgage rate. The new one has to include the cost of keeping the house insurable and livable. Construction data add another warning. In July 2026, privately owned housing starts ran at a seasonally adjusted annual rate of about 1,239,000 units. That was roughly 13.5% below the July level a year earlier. Single-family starts were also lower, showing that the supply response is not guaranteed to keep accelerating. 1 month does not make a trend, and housing start data can be noisy. But when the country already has a shortage, a sustained construction slowdown would make the long-term affordability problem harder to solve. The painful irony is obvious. High rates used to cool demand can also raise financing costs for builders and developers, making future supply more difficult to deliver. At the same time, building permits in July 2026 were running above their year-earlier pace. That means the pipeline was not simply collapsing in every measure. Permits, starts, and completions are different stages. A permit is permission to build, not a finished home. Financing can change, projects can be delayed, and units can take months or years to reach residents. This matters because housing headlines often cherry-pick whichever stage supports a preferred story. Strong permits do not erase weak starts, and weak starts do not prove construction has stopped. The responsible reading is mixed. The country needs sustained production, but the path from approval to an occupied, affordable home remains fragile. New rental construction has another catch. Much of the net growth in the rental stock over the past decade has been at higher rents, while the lower-cost stock shrank. That pattern is partly economic. New buildings are expensive to finance and construct, so brand-new units often enter near the upper end of the market rather than at bargain rents. Over time, some older units can become relatively cheaper as newer properties attract higher-income tenants. But that filtering process is slow and can be interrupted by renovation, neighborhood demand, or demolition. So building market-rate housing can relieve pressure, yet it is not a complete answer for the poorest renters. Deep affordability usually requires subsidy, lower land or construction costs, preservation, or some combination. Corporate ownership attracts enormous anger. So here is the fact that complicates the story. Large institutional investors own only a small share of the national single-family rental market, around 3% in a federal review. That national number does not make their influence irrelevant. Their presence is much heavier in certain Sunbelt markets, and federal researchers found evidence suggesting they may have contributed to higher prices and rents in some contexts. But the same federal review also said the effects on homeownership opportunities and tenants were not fully clear because definitions and data are limited, and many forces move housing markets. Blaming every unaffordable home on giant investors is emotionally satisfying and factually incomplete. Concentration can matter locally, but national scarcity, rates, zoning, land, construction costs, and household demand remain central. Homelessness shows the crisis at its most visible edge. Federal data counted 771,480 people experiencing homelessness on a single night in January 2024, the highest total recorded in that series. That was about 18% higher than the prior year. The count is a one-night snapshot, not a perfect census, and later conditions can differ. Still, the scale is impossible to dismiss. Housing costs are not the only cause of homelessness. Health problems, domestic violence, job loss, disability, substance use, family conflict, disasters, and other crises matter too, often in combination. But when low-cost housing is scarce, a personal crisis has fewer safe exits. A tight, affordable market can turn a temporary income shock into housing instability faster. Federal rental assistance is also far smaller than the pool of eligible households. Recent housing research notes that only about 1 in 4 eligible households receives federal housing support. That surprises people who assume qualifying for help means help arrives. In reality, housing assistance is not an automatic entitlement for every eligible household, and waiting lists can be long or closed. This creates a rationing system where two households with similarly severe needs can have very different outcomes depending on whether assistance is actually available. When people say the market should solve everything or government should solve everything, this is the reality both slogans dodge. The private market does not profitably serve every income level, and public assistance does not reach everyone who qualifies. Why not just build? Because local rules can make the answer slow, expensive, or politically explosive. Zoning can restrict apartments, minimum lot sizes can limit density, parking rules consume land, and approval processes can add time and uncertainty. Not every rule is pointless. Communities care about infrastructure, fire safety, congestion, schools, water, neighborhood character, environmental risks, and legitimate planning concerns. But every restriction has a price. When many small barriers stack together in a high-demand place, the result can be fewer homes and higher costs than would otherwise exist. This is the uncomfortable local politics of housing. People can support affordability in theory while opposing the specific building, density, traffic, or neighborhood change required to create more supply nearby. Several states have started overriding or loosening local barriers by allowing accessory dwellings, multifamily housing in commercial areas, manufactured homes, or more objective approval rules. These reforms are not instant price cut buttons. A zoning change does nothing if projects still cannot secure financing, labor, utilities, insurance, or buyers and renters at feasible prices. But rules determine what is legally possible. If modest apartments, duplexes, small lots, or accessory homes are forbidden across large areas, the market cannot build them no matter how strong demand becomes. Supply reform is therefore necessary in many places, but the hardest affordability cases still require help on the income or subsidy side as well. Now connect housing to the checkout line. When a low-income renter has only a few $100s left after housing, ordinary grocery pricing tactics stop being minor annoyances and start competing directly with medicine, gasoline, and utility bills. Package sizes can shrink while the shelf price looks familiar. Premium versions can anchor your eye higher. Convenience foods often charge more for saved time. None of this is secret, but stressed shoppers have less attention available to calculate unit prices. Store layouts can encourage impulse purchases. Loyalty programs can make the best price conditional on membership data. Coupons can reward planning. And private label products can sometimes offer lower-cost substitutes without changing the basic need being purchased. Delivery apps add another layer through markups, fees, tips, and frictionless add-ons. Housing did not create those retail strategies. It simply makes their consequences harsher because rent or mortgage costs already claimed the biggest share of the paycheck. This is why the official phrase cost burden can sound bloodless. The real experience is substitution. People substitute time for money, distance for space, roommates for privacy, older cars for newer ones, cheaper food for preferred food, and debt for cash. Every adaptation looks small by itself. Together, they describe a household reorganizing life around shelter. The crisis is therefore wider than the housing sector. Employers feel it when workers cannot live near jobs. Schools feel it when families move frequently. Hospitals feel it when unstable housing worsens health. Local economies feel it when disposable income disappears into rent. The burden spreads into nearly every corner of ordinary household budgets. A house is a physical asset, but housing affordability is social infrastructure. When it breaks, the costs leak into systems that do not appear on a real estate chart. So what would actually improve this? Start with more homes in high-demand places, including smaller and denser forms that are illegal or difficult to build in many neighborhoods. Just as important is preserving the lower-cost housing that already exists. Losing an old, modest apartment and replacing it years later with a much more expensive unit can increase total supply while still hurting the residents most at risk. The poorest households also need targeted assistance when the private market cannot house them at affordable rents. Supply can moderate prices broadly, but extremely low income can still require direct support. Construction friction matters too. Faster predictable approvals, infrastructure planning, financing tools, and rules that allow more types of homes where demand is strongest. Policy also has to confront ownership costs after closing. Insurance availability, disaster mitigation, property taxes, utility costs, maintenance, and association fees can undo affordability even when the mortgage itself looks manageable. That means resilience investments can be housing policy too. A stronger roof, safer electrical system, flood mitigation, or wildfire protection may sound separate from affordability until insurance or repair costs decide whether a household can stay. It also means buyers must stop shopping only by listing price. The true monthly carrying cost is the number that matters, and that number can change after closing. Affordability is not the price on the sign. It is the durable relationship between income and the full cost of occupying the home. Local fit matters. Some markets need far more supply. Some have weak demand and vacant homes. Some need infrastructure. Some need preservation. Some need disaster resilience. Some need all of the above. A policy that works in a fast-growing Sunbelt metro may be wrong for a shrinking rural county. A rent problem in one city may be a home insurance problem in another and a zoning problem somewhere else. National statistics are useful for scale, but housing is consumed locally. You cannot commute from a national average. That is why serious housing policy is frustrating. The problem is national in magnitude and intensely local in execution, and easy villains deserve skepticism. Large investors are not the entire crisis. Immigration is not the entire crisis. Zoning is not the entire crisis. Interest rates are not the entire crisis. Builders are not the entire crisis. Each can matter, sometimes greatly, but the evidence points to a layered system with incentives that interact. Removing one pressure can help without magically resetting the market. Ruthless accuracy is less emotionally satisfying than a conspiracy, but it is more useful. If the diagnosis is wrong, the cure can waste years while the shortage and affordability gap keep compounding. The most dangerous housing myth is that one lever can restore the market Americans remember from decades ago. So here is the full picture. Home prices remain historically elevated relative to income. Mortgage rates keep monthly payments high. First-time buyers are older and rarer. Low-cost rentals have disappeared faster than new supply can replace them. At the same time, millions of owners are locked into old mortgages, insurance and taxes are rising, construction is uneven, and assistance reaches only a fraction of eligible households. The result is not one housing crisis, but several stacked together. An ownership entry crisis, a low-income rental crisis, a mobility crisis, an insurance and carrying cost crisis, and a supply crisis that changes block by block. And that is why waiting for one magic number to fall will not fix it. Affordable housing requires more supply where people need it, protection of lower-cost stock, targeted help for the poorest households, and a serious attack on the costs that keep adding up after the keys are handed over. If this changed how you see the housing market, like the video, and share it with someone trying to buy, rent, move, or stay in a home right now. And tell me in the comments, what is the single housing cost hurting people most where you live right now? The purchase price, rent, mortgage rate, insurance, property tax, or something else?